of the QE or the interest rates going up. Oil price has created, drop has done a lot of good for India. It's also going to create social and political upheavals in several countries, all of which is not going to be good news. And some of these problems actually travel across shores to countries like India. Now we have an eminent panel who will explain what their views are about whether it's going to be this way or not. I'm sure there are two camps. One camp feels that yes, Acche Din aa rahe or aage, and there's another camp which says no, there's a lot of hogwash. So let me start by asking each one of them to give us their perspective in a couple of minutes about whether this is really Acche Din or not. It will set the stage for further questions. After I finish asking them all a number of questions, I'm going to turn the stage over to you, and you will ask questions and understand from their experience what things you can expect. So Mahesh, why don't we start with you?
So one of the nice things that Raj had done as a prelude to this was we had a chain mail going on about the quantum of how Acche Din are or is. And I had a slightly different point of view. And my point of view is that the Acche Din here is actually there, but it's not necessarily good for us. What does it mean? I look at this two different ways. When it's Acche Din, it's a great time to raise a fund because money is easy, people come and give it to you. But it's the worst time to invest in a company because valuations are at meaningless and ridiculous levels, right? So all the stuff that Ivan saw earlier about agricultural sector, all the money that's coming in, none of those LPs want you to invest in anything to do with agriculture. They all believe the right place for you to invest is in e-commerce, which is probably not the right place for you to invest in, right? Also, Acche Din out here, there's a lot of difference between the promise of the government and the delivered budget of the government. What the government has been very good at is in marketing. So you have a guy who's making trips around the world, wearing 10 lakh rupee suits, saying this is a great place to invest. And the people saying, yes, it must be a great place to invest. But actually, I really haven't seen that change happen on the ground. One of our companies, as usual, we're a registered SEBI venture capital fund, and the income tax department sends a notice saying that what I've invested in the company should now be taxed because it's income and it's not an investment. So there's a huge difference between the apparent promise of the government and the apparent delivery of what is supposed. When even a venture capital investment from a registered fund is seen as taxable income as opposed to an investment, you know that there's a lot of gap between the cup and the lip. I think the bigger issue out here is that we have been surfing, we're kind of engaged in part of the global economy. When all of us went out to raise funds during the Lehman crisis, none of us were able to raise it from the US. When Greece happened again, and Greece seems to be happening every 2 years, it hits all of us. Whether it's Lehman or whether it's Greece or whether it's whatever else, the dot-com crash, these are not things which are within our control. These are not things which you can, even in the greatest of your imaginations, credit the BJP with doing or not doing. Right? It so happens that at one particular global moment in time, everything seems to be going up. So currently it's a great time to have been in the stock market 2 years ago because you would have made 100% by now. It's a horrible time to get into the stock market now. So Acche Din to me means, like I said, it's a mixed blessing. It's a good time to raise money. It's a sucky time to invest money. The valuations there are meaningless. At some point, you don't want to get into any of the sectors which have so much capital out there. We talked about capital efficiency, and how you need to prune your spending. I was looking at some numbers the other day. Yesterday it was reported that Amazon has brought in another 1,100 crores into India, which brings their total in India up to 3,800 crores. Their rival Flipkart has raised 10,500 crores, and both are about the same size, which means one company is 3 times more cash efficient than the other at reaching exactly the same amount of revenues, right? So you're seeing out here that the market is rewarding the cash inefficient companies as opposed to the cash efficient companies. At some point, this rigmarole will stop. At some point, economic sense will come back, right? Till then, we can keep deluding ourselves and keep telling the world and keep telling our LPs, Acche Din are here to be able to take the money. But I think we've got to think 10 times before you put money behind anything trendy. So as far as investments go, these are not Acche Din. As far as raising funds go, these are very Acche Din.
Anita, what's your view?
Raj, I hope you have the other two panelists saying something more positive. because on this side it's going to be quite a different message.
They told you what to talk about.
I think the level of the Sensex is not a necessary or a sufficient condition for Acche Din. In fact, we have had a couple of IPOs in the last 1 week or so which were heavily undersubscribed. And if you look at he talked about the promise and delivery, which is also the case. If you look at the budget rather closely after, I myself wrote a pretty positive piece immediately after the budget came out, but the more I look at it, the more I have questions about the funding, about the non-recapitalization of banks, because all the initiatives in the budget are dependent on the flow of credit, not only to the government corporations, but also to the private sector. So you can't ignore this 800-pound gorilla in the room, which is the non-performing assets problem. And also I must say that the Indian corporate sector too was quite leveraged going into 2008 crisis. It continues to remain highly leveraged, one of the most highly leveraged private sectors in the world at the moment, especially among the key emerging market countries. And on top of that, they have been borrowing in the foreign currency market as well, which is what caused them some problems in 2008 and 2013. I don't think it has abated. Now, whether or not the United States goes through with its rate increases in 2015, the fact remains, as he put it, about valuations in the companies that you want to invest, valuations in financial markets, especially if you look at the United States. It is only the second highest in terms of S&P 500 valuations, second only to the 2000 dot-com bubble. Now, we all know that when the US stock market corrects, global correlations go to 1, which means everybody falls. So it doesn't matter whether you have Acche Din domestically or not, it will necessarily lead to a correlated decline in other markets too as well. And you also look at the relationship between the government and the Reserve Bank of India lately, it doesn't look very good. And that is not a good sign for a coordination of fiscal and monetary policy. So I think the beginnings and the gradual process of rectifying the major imbalances created by the previous government started off on a good footing last year. But subsequently, I think there has been some sort of a drift and lack of clarity in policy. And on top of that, notwithstanding the oil price bonanza that we have received, there are very big gaps and unaddressed questions, both in the budget and in other policy areas. And on top of that, as you mentioned about the global markets and their likely trajectory in the remaining months of this year. So we need to be very clear that one of the things that we can do as investors or as corporations in the field is to keep our feet and ears to the ground. Because from time and again, we get lost or get carried away by the slogans and the euphoria created by perceptions. But the reality is not dictated by or reflected in Sensex valuations. That's my point.
Thank you. Now, Vish, your turn to speak your mind, although you've been told to say something good.
Thanks. Can you guys hear me? Yeah. So I guess before we figure out Acche Din aane wale hain or not, I think it's useful to take a step back and see the couple of previous cycles. So if you look at the cycle from 99 to 2003, where there was a lot of growth, or the cycle from 2003 to 2007, and then now this current cycle. So some of the interesting facets of the previous cycles. The first cycle was really about IT growth. It was all about the Indian IT companies, whether it's Infosys, Wipro, etc., becoming large global players. And most of the wealth creation at that time was either because of sentiment of the US-led IT growth or some of these Indian companies doing well. The next phase, actually from 2003 to 2007, was really a lot of growth because of asset inflation. So if you look at the price of gold at that time, it was roughly 4,000 rupees. If you look at the Sensex, it was at 5,500. And in 2007, gold price had gone to 18,000. The Sensex was at 20,000. If you look at real estate prices, and for most people who would have had apartments or owned land, and this is a very widely owned asset class in India, most people have seen asset prices increasing substantially during that time. So land prices have, doubled or tripled. Asset values in the major cities have also gone up in the same proportion. So if you look at, say, equities, which is, the wealth effect coming out of the Sensex going up, only 2% of the country actually owns equity. So it's not a widely, the wealth effect coming from the Sensex going up from 5,500 to 20,000 is not really widely felt. It's probably felt more in Bombay rather than other parts of the country. But the real estate inflation did create a lot of wealth effect, and there was a consumption effect of that asset inflation that came about and led to a lot of growth, which led the GDP to go up from 6, 7, 8, even 9% for a couple of years. As we look forward now, gold prices are at 26, 28,000. The Sensex is where it is, as you guys know. Real estate prices now are almost at global levels. In fact, at large cities, they are pretty much in the same ballpark as some of the largest cities in the world. So using or depending on asset inflation as the next driver of wealth creation is going to be very difficult, because this kind of equalization or the repricing of assets happens in a short period of time, which has already happened for India. So now, whether the Acche Din happen or not, my view is Acche Din aa sakte hain, but it will be hard work ahead. It'll have to come from job creation. It'll have to come from the Make in India, the real economy kicking in, rather than some of the shortcuts the previous government have had because of some of these wealth creation effects. So net-net, I think I am positive on the government. I think it's a significant change from the previous dispensation. At least there is a thought-through process of what needs to happen across various sectors. Having said that, it's not going to be easy. I think it's creating 10 million jobs a year, which is what we need to create, is going to be very, very difficult. And a lot of things have to go right for that to happen. But I think finally, at least there is a captain at the rudder of the ship, rather than a directionless ship going nowhere. So cautiously optimistic is what I would state my position.
Thank you, Vish. And Rajesh, your turn to enlighten the audience.
Yeah, I mean, if you're expecting a lot of positives to come from this end, I guess we're not going to hear that. Of course, as a venture capitalist, I would like to be optimistic, especially when the technology segment is attracting not only a lot of capital, a lot of interest, euphoria, etc., but like what Mahesh mentioned, it's a double-edged sword, and things can be positive in a way, but we're also worried about quite a few things going wrong, and that has a ripple effect, and it has a long-term shock can be quite bad, not just for the technology sector, but for India as a whole. And like other panelists pointed out, I think we cannot be shielded from global shocks, and some of the numbers that we look at, I think we need to look at what's happening around the globe rather than just India. And as a venture capitalist and as a technology investor, if I look back, having lived through the dot-com bust in the late 90s, the numbers are eerily similar what we're seeing today, if not worse, in terms of the euphoria that was created in the dot-com bust. If you look at the number of companies that got funded, whether it's early stage growth and late stage in the 99, 2000, 2001, if you take those 3 years as a peak years during the dot-com bust, there were about 6,000 deals done, and in 2013 and 14 alone, we crossed 12,000 both years around the globe, which is just a unbelievable number. And if you look at the number of dollars invested, those 3 years combined to now, in 2014 alone, we have crossed the total dollar volume that was invested in those 3 years. And if you look at the valuations and the kind of companies that are getting funded, it's no different from the from the dot-com bubble. So the signs are very, very similar, and one more time I hear the phrase, this time around is going to be different, I cringe. And we've heard through the late 90s many, many times, this dot-com era is going to completely change the economics and the way consumers spend, the way the consumers spend on digital versus non-digital. All those stories we've heard. Similar stuff around the real estate bust in 2008. The real estate in the US is dramatically different. The way you value real estate in the US has changed. This time it's going to be this time it's going to be different. All those things are always the phrases one uses to justify unbelievably and crazy valuations. And I'm beginning to hear that now. I've heard that in 2014. I'm hearing that again in 2015. So I'm very cautious. I would like at least my firm to be cautious. The unfortunate thing about these bubbles is some good companies get lost in the mix. And I'm not worried about the top companies. I think the large companies are obnoxiously valued. That's what a lot of people tend to say, whether Flipkarts or Snapdeals, whatever the two large, highly valued companies in India, they'll be fine. I think Amazon was also thought to be highly valued in the late 90s. And as a leader, I think as a leader, you will be able to raise money even during bad times. You'll survive, you'll come out thriving, in fact, because all the fringe players have disappeared. So it's actually an advantage for the leader. My worry is for the larger tech ecosystem and how they're going to survive through a crisis. And so one of the things I would caution entrepreneurs is don't be a Me Too player. And just because very cash inefficient models are getting funded, and there are no revenue models or profitability models in place, they may be funded in 2014 and 2015. That may not be the case in 2016. So I would be very, very careful when you're thinking about your business models to really think through how you're going to survive through a tough time. So of course, raising cash and having cash in the bank is the number one thing we advocate to our companies, but that's not good enough. I mean, that cash will eventually run out. Because the most aggressive, not entrepreneurs, but the investors that you see today, most of them are the fringe players who are not the core investors, and they will disappear first. And even the core investors who may or may not be aggressive will become ultra-conservative. And if you look at the dot-com bust, most of the investors, VCs in fact, who should be the most aggressive investors in the market because we take tremendous amount of risk and expect high return, gave a lot of money back to their limited partners, saying that we're not able to find any investments. In 2002, 2003, it has happened. Most of the funds returned money back to the investors. That's not true. They were entrepreneurs looking for money. These guys have become completely conservative, didn't want to put a single penny at risk. So the aggressiveness will quickly become total conservative flip that could happen. So be cautious, and we'll talk about more things.
Thank you. So you've heard views ranging from cautious optimism to warning that you should be cautious. Okay. Now, my question to Vish is, does it really matter whether Acche Din come in 2015-16 or not? After all, the founder, of your firm, TPG Growth, Bill McGlashan, was very optimistic. He in 2013, when things were bad, he relocated to India. And I remember he said that despite the storm clouds, this is the best time for a PE fund to be here and back and build great companies. Do you hold that view in 2015?
I think that's a good point. I think, look, there's no denying the fact that India is a 10, 15, 20-year macro. So while Mahesh and others who have commented, there are cycles in which valuations run up, fundraising happens a lot. I think over the longer period, I think, I am very optimistic. As you said, Bill is very optimistic. I think the fundamentals of, and we all know this has been said many times, on the demographic dividend, 1.3 billion people, the middle class, the consumption economy. So all of those facets of India are still there. some of the challenges China has had, for example, which is essentially the consumer not coming through, or Brazil has had, where commodity prices and the dependent on commodity prices is so high that the volatility in the economy, whether it's Brazil or Russia, is very high, and commodity prices going down really has a very dramatic effect on the growth. In that sense, India is much more insulated because our GDP is still 60% driven by consumers. And that will continue to grow throughout some of these cycles. So over the long term, we remain optimistic. I think the question is, given the expectation that has got built up, I think that's the challenge, where the marketing has got ahead of itself in terms of it's too much as expectation has got built up too soon. So it would have been actually better if this would have been a more gradual process. But look, these things always happen. There is, frankly, in my view, it's better to have a little bit more euphoria. People were so negative on India, and we've just raised a $3 billion fund, and when we go to VCs or sort of LPs, their view was so negative towards India that some bit of positive boost here is actually a good thing. And while there will be some irrationality over the next 1 or 2 years, overall, I think for the mood of the global community to change for India, some bit of this marketing was, in fact, necessary or even essential.
Thank you. I'm looking for some interventions from the three of you, but keep it very brief. Mahesh, do you agree with this view? Or disagree?
So broadly,
more pointedly, the question is, should individual entrepreneurs bother about the macro or the micro?
So I don't think entrepreneurs should bother about either. I think you build your business as long as you figure out. See, the dynamics of a successful business have changed. In the world that I grew up in 30 years ago, you could be a number 5 company in a sector and do very well. Today, nobody even knows who the number 2 search engine is on the planet. Nobody knows which the number 2 site is on the planet. Today, it's become a number 1 and nothing game. So as a result, then the copy-paste don't work. So you can't build the Indian Google because the Indian Google is Google and so on and so forth. So we know that. I mean, you find a niche that nobody else has touched, especially an American company has not touched, build 80% market share, and you will certainly succeed. You do this, and you try to be in a space which is not competitive. The problem with being in a space like a Snapdeal, Flipkart, Amazon is that all the profits have been sucked out of that market. Why should anybody go there? I mean, everybody's A, spending more on discounting, and B, spending more on marketing to say that they're discounting, which is a lose-lose situation, right? So it's one of those last man standing games. So from an entrepreneurial point of view, stay away from competition, build monopoly. I mean, that's one thing I'd say. But from a broader point of view, I mean, to Vish's point, we're at a point in time where things are just aligning a particular way. It so happens that right now, for an LP who's looking at asset allocating across the world, China is on the decline, Europe is going nowhere, and the US, if you're not in the right fund, you're nowhere, right? Which kind of says, okay, fine, there's India left. That's not necessarily due to something good we've done. It's about also due to the fact that somebody else has landed up in a bad state elsewhere. Things might change. We can't forever depend on China being a declining story. We can't forever depend on Europe not getting its act together, right? Because those seem to be 2 big reasons why people are coming to India, not necessarily due to an inherent goodness of our own. I applaud the fact that we happen to have landed up in a position where we are better than others, right? That said, I'm not pessimistic on India. I wouldn't be here if I was. I do believe in long-term investing. You have to take 15, 20 years. The problem is that no VC fund or no growth fund has 15, 20 years. They're all 8 or 10-year funds. So in that 8 or 10 years, if you invest too early at the early stage, which is where you get the valuation bump, you're not going to be able to see it through to the end. If you come in late, like if you're the guy who's investing in Flipkart at a $15 billion valuation, you must be sitting on a knife edge, right? Because you want to sell that company at $30 billion or $45 billion. $45 billion is 300,000 crores. There's only 3 companies in India that's more valuable than that. Are you really saying that you're more valuable than Reliance, you're more valuable than Mahindra, you're more valuable than Bajaj? It's a big ask, man, right? So my point is, I mean, if you've come in early, then you've got to be able to stay late. Also in the earlier presentation, it was pretty interesting to figure out that all the exits happened for less than 3-year investments. The early exits, and there's a lot of it, there's about $20, $30 billion worth of money which has been stuck, which hasn't gone back out. So from an entrepreneur's point of view, don't worry about this stuff. Go build your business as long as you build a dominant business and build it at a tight price. I do want to add another aside. One of the things we learned, and we call it almost, we self-disparagingly call it kind of our effect. I raised my first fund in 99, started investing. In 2001, the world crashed. We raised the first seed fund in 2006. In 2008, the world crashed. We raised seed fund 2 in 2010. In 2012, the world crashed. So we have a innate ability to raise a fund 2 years before the world crashes. So we are raising a new fund now. 2017,
So 2
the world
years
will
from now,
crash.
the world is going to crash.
So 2017, the world will crash.
Watch out for
You know,
2017.
we've had some precedent to, you know. So that said, the bigger point out here is that you have enough money to make sure that when the world crashes, that you can survive, as opposed to saying, it's a lovely world, I'll just raise some money, I'll spend all of it on advertising. In fact, the most successful companies in this e-commerce era today are the Times of India and Star Plus, right? Because they're making all the revenues. Nobody else is making revenues. Do you have enough money so that when the world crashes 2 years from now, as we have seen incontrovertible proof that it will, right? You can survive when there's no next round coming in. I think from an investor's point of view, that's really important. Take enough money, make sure that you're not there making Mr. Jain rich or Mr. Murdoch rich. Build your own business, fundamentally build it out to be a strong business. It will turn. All you've got to do is survive when it turns. That's my point.
Great. So all of you know that there's one more lead indicator. If this guy raises funds 2 years from now, crashes imminent. Now, talking about the possibility of these things crashing, do you see anything that in the air which will make some of our Indian boats sink? People didn't see the 2008 thing coming, the business people. Do you see any problems or any way out if there are problems? But a very brief answer,
Sure.
please.
No, I don't think we will sink, because I think those kinds of major dislocations did take place in 2008, and India in a way was lucky that it faced its mini squall in 2013. So I don't think if there is a global stock market crash or some other major issues happening in Europe or in China, I don't think we will have a major backlash here. So I think it will be a problem, but it won't be a major one.
That's a relief. And do you agree with what you heard?
I would like to make sure that I'm clear on what my earlier statements. They were about the tech bubble and how where we are today is really similar to where the world was in 1999 or 2000. But having said that, I'm an extremely optimistic person when it comes to India. India has a long way to go, and although we tend to think of ourselves as a longer-term investors, it's still, to other panelists' point, we still have to take the 3, 4, 5-year cycles, and the economy and the overall life cycle may not come back to correct and give us enough exits and enough returns. That fear is there. But having said that, India today, all the macro factors are pointing in the right direction, and I think the consumer is just waking up, and we see a tremendous appetite from the consumer side, regardless of what the government does or what the businesses do. Consumer is really driving, I think, the Indian economy, and they'll continue to drive because the appetite is immense. And of course, a number of companies are trying to cater to that appetite. But having said that, the shocks, in my view, India cannot be completely shielded from the shock. And it could come from the US because number of these, it could come from a very narrow sector. When you look at technology, it's not the sector that drives the entire world. But unfortunately, .com bust in the US in 2001 had a ripple effect around the world. That's what worries me about India, not the macro or fundamental factors, not the longer term growth potential. We have all the signs in terms of demographics and the government, all the macro factors, everything is aligned for us to prosper. Unfortunately, these shocks could completely detour the entire growth that's possible in India.
Thanks. Now, while on the same subject, I want to come back to what you said. I'll put it slightly differently. They say that there's an old saying that the barber tells you what share to buy, there's a crash imminent. Today you find hedge funds investing or playing in the territory of venture capitalists. Do you see it as a sign of something to come?
I mean, I agree with you. It's an important pointer. Even though Mahesh made us feel comfortable, it's only 2 years away from now. I wouldn't go by that rule of crashing, because obviously we all know that past results are not a guarantee of future results. So I think you're right about the fact that not just that indicator, but you look at the kind of valuations that some of the US in social media firms got last year. We forgot about WhatsApp and Twitter, etc. So and also look at the kind of spreads at which junk bonds are trading worldwide. And you look at the websites of many central banks in the world, almost everybody has negative interest rates. Do you think it's normal